Welcome back to the deep dive. Today we are plunging headfirst into one of the most explosive and frankly fragile financial phenomena of our time, the AI stock market bubble.
And it really is explosive. If you've been watching the headlines, the numbers have become, well, completely unhinged.
Unhinged is the right word. This isn't just normal market volatility. We are looking at a system that feels like it's fueled by pure speculation, where prices just seem to defy all logic.
That's absolutely right. And what we're analyzing here is considered by many, seasoned analysts to be the single largest bubble in U.S. stock market history.
The largest ever.
The scale of the movement is often just, it's faster than human comprehension. We've seen these crazy manic swings where hundreds of billions can be added or wiped out in a few hours.
Hundreds of billions in hours. I mean, that sounds less like trading and more like an algorithm just running wild. Our sources even highlighted one instance where, after a scare, the S&P 500 lost a staggering $2 trillion in market cap.
In 5 hours.
In just 5 hours. And that volatility, that's the key symptom here. It's not the disease itself.
Exactly. So our mission today is to look past the hype machine, to really analyze the underlying mechanics of this mania. We need to understand the major financial red flags that are, for the most part, being ignored by the wider market.
And also the geopolitical pressures that make this situation not just volatile, but fundamentally systemic and dangerous to the global economy.
Okay, let's unpack this and start at the core.
Let's do it.
So when we talk about a financial bubble, we're really talking about a valuation that's completely detached from fundamentals, right? It's driven by risky speculation and this kind of herd mentality.
Yeah, it's that line always goes up thinking.
Exactly. So what is the single crucial company fueling the engine of this bubble?
The core driver is, without a doubt, Nvidia. What's so fascinating here is their position in the market. They currently hold what is essentially a global monopoly on the design of the most advanced computing components.
The GPUs. The GPUs, exactly, which are necessary for training large AI models. Think of it this way. Everyone else is rushing to strike digital gold, but Nvidia is the only company selling the shovels. That's a great way to put it. And that unique control has vaulted Nvidia's CEO, Jensen Huang, into this sort of visionary status. The source material notes he's celebrated everywhere, with memes suggesting Nvidia is practically holding up the entire U.S. and global economy. And he hasn't exactly been shy about that claim either. He reportedly told his employees, and I'm quoting here, "We're basically holding the planet together, and it's not untrue."
Wow.
That kind of confidence is built on the fact that Nvidia was the first company in history to reach a market cap of more than $4 trillion. But this is where the paradox really starts to emerge.
A paradox. Okay, so why is this bubble maybe fundamentally more unstable compared to, say, previous tech manias?
Because of where the profit is actually coming from. Nvidia is making enormous amounts of money because its primary customers, the big tech giants and the startups trying to build AI,
Are losing money. They're losing huge amounts of money buying its chips. They are just pouring capital into infrastructure that is not yet profitable at all.
So Nvidia is only profitable because its entire client base is highly unprofitable and spending money they don't really have yet.
Precisely. Nvidia is succeeding in the short term because of this peak capital expenditure, but its profits are built on the unsustainable, massive losses of its primary buyers. Eventually, if those customers continue to hemorrhage cash at their current rate,
Then demand dries up.
their demand will dry up, their valuations will collapse, and the entire financial scheme will follow. It's interesting, even OpenAI CEO Sam Altman, who's a huge beneficiary of this boom, has admitted that he believes AI is currently in a bubble.
That makes it sound less like a sustainable market and more like a pyramid of IOUs. To grasp the sheer scale of this, we have to look at the Magnificent Seven, the Mag 7. These are the giants: Amazon, Apple, Google, Meta, Microsoft, Nvidia, and Tesla. And their concentration in the market is just staggering. Collectively, the market cap of the Mag 7 is larger than the entire stock market of Europe.
Or even China.
Or China. It's incredible.
Correct. As of November 2025, these 7 corporations accounted for a full 35% of the S&P 500 index. Now, that level of concentration is a massive risk factor in itself, but it gets even more precarious when we connect this dependency to the bigger picture of the U.S. economy.
Tell us about that. The source material had a pretty shocking number about GDP growth. It did. A Harvard economist released a major finding. Investment in information processing equipment and software, which is, overwhelmingly AI capital expenditure, or capex, made up an astonishing 92% of U.S. GDP growth in the first half of 2025. Wait, hold on. 92%. That sounds almost statistically impossible. Can you break down what that actually means?
It means that without big tech pouring billions into buying Nvidia chips and building these vast data centers, that's what capex is, U.S. GDP growth would have been a near stagnant 0.1%.
So the official growth of the entire U.S. economy right now is almost completely dependent on the Magnificent Seven continually buying infrastructure from each other to sustain the AI hype.
That's it. The health of the entire U.S. economy is essentially contingent on this AI bubble continuing to inflate.
And that feeds directly into what our sources called this circular financing scheme.
Exactly. Because these big tech companies are so deeply intertwined, they're investing in each other, trading commitments, future debt, making it look like money is being made across the board,
But it's just the same capital circulating through IOUs.
creating a false impression of health. The clearest and maybe most disturbing example of this circularity has to be OpenAI.
Right, the private company.
Because they're private, we have to rely on partners for data. And Microsoft, a key investor, revealed that OpenAI lost a devastating $12 billion in just one quarter.
$12 billion in one quarter.
And despite this, OpenAI owes a staggering $1.4 trillion in long-term commitments for Nvidia chips and data centers.
1.4 trillion. To put that number in perspective, that's bigger than the GDP of most countries. That's a stunning commitment for a company losing money at that rate.
It is. And this raises a critical question. Why is Nvidia selling to customers who are so clearly unsustainable? Many analysts believe Nvidia is actively propping up its own customer base to keep the whole thing going. So they're financing their own customers to keep the capex flowing, which keeps the GDP numbers looking good and keeps their own revenue chart soaring.
It's a very precarious loop.
Okay, so despite the superficial announcements of soaring profits in Nvidia's earnings reports, the kind of news that makes its market cap shoot up, analysts looking closer have found some major red flags.
Yes, red flags that suggest deep fragility just beneath the surface. So let's start with the most immediate risk. Who is actually buying all these chips? The first massive red flag is customer concentration. This shows the vulnerability of their whole revenue stream. The earnings report revealed that just 4 anonymous customers, presumably other Mag 7 members, account for a massive 61% of Nvidia's revenue. 61% from just 4 customers.
One customer's 22% alone, then you have 15, 13, and 11%.
That is an enormous risk. If just 1 or 2 of those anonymous big tech giants decides to cut back on their capex, if they decide they've bought enough shovels, Nvidia's revenue and net income will plummet immediately. And it'll take the market with it. And that risk is compounded by the second red flag, the huge rise in accounts receivable. Okay, so for listeners who might not be diving into corporate balance sheets every day, can you explain accounts receivable simply?
Think of it as running a massive tab. It means Nvidia is selling more and more chips to these few powerful customers on credit.
IOUs.
Basically. They're giving out IOUs because the customers, like OpenAI, don't have the cash on hand to pay. As this tab grows, it raises very serious concerns about whether they'll ever get paid back.
So the profits they're reporting aren't actually cash in the bank.
A lot of it is promised payments, based on credit to customers who are losing money hand over fist. They're betting that profitability just magically appears before the bill comes due.
What about supply? Isn't there this narrative of unstoppable, insatiable demand? That narrative is directly contradicted by the third red flag, inventory. If demand is truly insatiable, inventory should be low. Chips should be selling the moment they're made, but they're not.
Instead, Nvidia's inventory, the products they have sitting on shelves, unsold, is skyrocketing. It reached $20 billion. That's a tripling in just 1 year.
A tripling of unsold stock, that completely contradicts the idea of a constant urgent shortage. What does that imply?
It implies that demand is either slowing or the company is overproducing based on unsustainable forecasts. It fundamentally chips away at that core narrative of we can't keep up.
And this fragility is compounded by external risks, right? Specifically geopolitical ones. The source also dismantles this idea that Nvidia has a permanent moat.
Yeah, the narrative that Nvidia will always dominate is dangerously simplistic. Geopolitics is key here. China is heavily prioritizing challenging U.S. dominance in cutting-edge chips.
Companies like Huawei,
Alibaba, Baidu. They're investing massive amounts of state-backed capital right now to develop their own AI GPUs.
How does that practically threaten Nvidia?
Well, in the short term, it threatens their market share in Asia. But more importantly, it threatens their pricing power globally. If China successfully develops viable alternatives, competition drives prices down.
And that eliminates the monopoly profit margins Nvidia relies on to justify that $4 trillion valuation.
Exactly. It fundamentally threatens their entire growth narrative.
These deep financial fragilities, they really explain the violent volatility we've been seeing. Those sudden, massive losses prove this market is driven by sentiment, not rational accounting.
We saw it when Nvidia's market cap fell by $600 billion in just one day.
Right after a huge earnings announcement, too. And the fear spread instantly. That $600 billion loss was just the beginning. The wider S&P 500 fell by that $2 trillion we mentioned earlier. The collateral damage was immediate. Oracle fell 44%, Palantir 30%, Meta 27%. It just shows how quickly the entire house of cards can start shaking.
It really sounds like a classic speculative bubble mentality. Everyone sort of knows it's unsustainable, but they keep trading, assuming they can get out before the music stops.
Yeah, that famous quote from John Maynard Keynes comes to mind. Markets can remain irrational longer than you can remain solvent. That's exactly what we're seeing. Everyone knows it's fundamentally irrational, yet the speculation just continues.
This mentality reminds me, chillingly, of the time leading up to the Great Depression.
It does. In the 1920s, you had nonstop propaganda claiming the market had entered a golden age, that the party would never end, that irrational exuberance was a huge contributor to the 1929 crash.
And the decade of economic disaster that followed. Today, we face a very similar structural risk. The global economy is so deeply financialized, and so much of our recent growth depends on this single massive financial house of cards continuing to inflate.
So the core systemic danger here is the concentration. The concentration of economic activity and risk.
It is. The U.S. economy's growth depends on the spending of just 7 companies, and the deep financial fragility in the accounts of their main supplier, Nvidia. With mounting inventory, just a few customers, and huge debts owed. It all means the AI economy represents an unprecedented level of risk to the global financial system.
So when this largest bubble in U.S. history finally pops, the consequences will be catastrophic because the system is built to instantly spread that fear and selling pressure across global markets in a matter of hours.
While the bubble may continue to inflate for some time, you just have to remember that this concentration of risk is unprecedentedly high. When those 4 anonymous customers cut their orders, the dominoes will fall.
A sobering but essential thought to leave us with. Thank you for joining us for this deep dive.
Thanks for having me.
Until next time, keep analyzing the market forces and financial structures that exist beyond the hype.
Just a laugh when you grab, make your move.